Hello learners, welcome to the financial management video classes. Today I am going to discuss capital budgeting techniques in the investment decisions. Capital budgeting is a process of making investment decision in long-term assets. Capital expenditure which is incurred today is expected to bring benefits over a period of time. These expenditures are related to the acquisition or improvement of the fixed assets. In general, capital budgeting is the planning of expenditure and the benefit which spread over a number of years. It is a process of deciding whether or not to invest in a particular project. Now let us understand what is capital budgeting. The capital budgeting is a strategic financial management process used to evaluate potential major investments or expenditures. Because the capital budgeting methods or techniques will help the organization to decide the desirability of the investment proposal. And for financial managers, this capital budgeting techniques will act as a tool for them to take viable decisions. The famous and popular financial management author Charles T. Horngren stated, "Capital budgeting is long-term planning for making and financing proposed capital outlays." We have two types of categorizations. One is the traditional methods and another one is the discounted cash flow methods. Before that, let us understand the importance of the capital budgeting techniques, as it facilitates long-term strategic planning. Whenever we talk about capital budgeting, think that we are talking about the long-term investment. And long-term investments like coming up with a new project or modernizing the existing plant or new venture development or acquisition, because it involves substantial initial investment. If I want to start a new project, I need huge capital requirement. And if I make a wrong decision in choosing the project or in my investment decision making, it is going to affect the entire organization. Sometimes it may lead to collapse of the organization. It affects the future profitability and cash flows. Because whenever we are talking about the initial investments, cash outflows will be there from the organization. So maybe in the next 1 or 2 years, the company may not receive the cash inflows. So the profitability will reduce. But after the completion of the project, say after 3 years or 4 years, the cash inflow starts getting and it affects the profitability of the organization. The capital budgeting techniques will help the financial manager in comparison with other proposals. Because say for example, project A is there, project B is there. If I want to compare, on what basis we are comparing. So we have benchmark decisions, as we have different techniques. Traditional techniques are there, modern techniques are there. We deploy those techniques on the proposals, then we take a decision based on the benchmark decision rules, and it becomes easy for the financial manager at least to identify which project is worthy, feasible, financially feasible for the investment, strategically feasible for the organization, as it supports the resource optimization and the risk minimization. Because at the time of the investment selection itself, we are considering certain factors in selection of the proposal, and alternatively we are also selecting other proposals. Suppose if financially if this A project is not feasible, then I'll go with the project B. So here we have the first traditional method, which is called as payback period. Most popular and widely recognized traditional method, first of its kind. Maybe we can say as a thumb rule for the financial decision makers. In simple, we define the payback method as the number of years required to recover the entire initial investment invested in the project. For this particular method, merits or demerit. One of the major demerit is it ignores the time value of money. And another one is, see, the project period is 3 years. Project life of the project is 5 years. And within 2 years, the project has recovered the entire initial investment. But it doesn't consider the next 3 years cash inflows. That is the demerit which we can observe in this particular method or technique. That's why called as sometimes it misleads the evaluations done by the financial manager. When it comes to the merits, yes, it is very simple to calculate, simple to understand, very easily we can understand, very quickly we can take the decisions if we go with the payback method, which can be calculated using the formula payback period is equals to initial investment by the annual cash inflows. Here the decision rule, when it comes to the decision rule, on what basis we are accepting the proposal, on what basis we are rejecting the project, as definition clearly states that in how many years you are recovering the entire investment. That means our decision is based on the period of the recovery of the investment. So whichever is shorter payback period, we have to accept that particular project. The second method, accounting rate of return, which evaluates the returns which are generated from the accounting profits rather than cash flows. It is also easy. It is also one of the traditional method. Easy to calculate, easy to understand, considering the accounting information, based on the accounting, based on the statements. But it ignores the time value of money. It ignores the reinvestment potential of the project. As for calculating profit only, we are not clear what kind of profit it is. The profit term itself is a very unclearly defined term. Whether profit before tax or profit after tax. So some difficulties we may face in the calculation of the project. So which can be calculated as average annual accounting profit by initial investment, and we are multiplying with the 100 because accounting rate of return which is measured in terms of the percentage. That means how I am evaluating the projects in terms of the percentage. So if it exceeds the required rate of return, then I will accept the proposal. Suppose project A is giving 15%, project B is giving 16%, and if my required rate of return is 15%, definitely I will go with the project B because project A is giving only 50%. Another important technique is the net present value, which is defined as the difference between the present value of cash inflows and the outflows of the project's life, discounted at a required rate of return. It is one of the widely recognized modern method in the capital budgeting, where it recognizes the time value of money. It considers the total benefits arising out of the proposal. And the NPV method is helpful when we are having mutually exclusive projects, but it cannot be applied when we have different life of the projects, when we have different period with the different period or with the different life of the project. That time we cannot apply. If we apply also, that's not feasible to take a financial decision. To calculate the present value, we need the discount factor. Without discounting factor, we cannot calculate the net present value or present value of the cash flow. Present value cash flows we cannot calculate. That is another important demerit for this particular method. So this is here the decision rule. NPV if it is greater than or equal to 0. If NPV is greater than 0, just accept the project. If NPV is less than 0, reject the project. If NPV, in certain cases, strategically, if I want to take certain decisions as a financial manager, even there are some cases where NPV is equals to 0 also, we may accept the proposal keeping in mind the other strategic perspectives of the project or investment. So an initial investment of 1 lakh is expected to yield 30,000 annually for 5 years, and the discount rate is 10%. So I have considered as, because why we have taken annuity factor, because the stream of cash flow, even stream of cash flows we are receiving. So here what we are doing, here I am taking this present value annuity factor as 10% for the period of 5 years. So if we simplify, and this is the initial investment minus initial investment is a 1 lakh. So I am getting rupees 13,000. It is a positive. So hence we are accepting the proposal. Next, internal rate of return is the discount rate at which the present value of future cash inflows equals the initial investment, and it is also one of the modern technique where it considers the time value of money. It accounts